Don't forget that. Welcome to Silvercrest Opportunity Fund. Passive, really I think this massive, stable cash flow, lavish, about to finance for the masses, this 14% in manufactured housing. Really all the deals I've been doing is kind of hard to keep them counting. Not really, 10% for the year, it's clear that bitch the new wave. Do you have $50,000 to $100,000 liquid, or maybe even up to $1 million, and you're looking for a passive return outside the stock market, maybe in a long-term rental strategy, looking at multifamily syndications, or maybe a note investment? Well, I'm here today to put up against, in comparison, a long-term residential real estate rental strategy up in compared to the notes that we originate at a double-digit yield. So today is May 16th here in Scottsdale, Arizona, and I originate notes for a double-digit yield in manufactured housing in a Warren Buffett investment strategy. Well, when you go out and buy a single-family property for a long-term rental program, you're going to end up probably garnishing a loan as a DSCR loan or a cash-out refi from an existing investment vehicle. What does that look like? What are interest rates right now on a DSCR loan? It's probably around 9%. And the average single family property is $450,000 here in Arizona, and pretty much nationwide now that the institutions like BlackRock, Vanguard are wanting to own 30% of single family properties in the nation. It keeps that price ultimately at above a $450,000 price point on average, really nationally in every metropolitan major market in the nation. So 20% down for a DSCR loan at a 9% interest rate, 9%. For a long-term rental strategy. Boom. And let's go with the mobile mailbox money comparison. And a double-digit yield, contractually agreed upon return with non-fluctuating payments in first lien performing notes that we originate here in one of the hottest markets in the country, most desirable, most dynamic, Arizona here in the Valley. Long-term rental strategy, average purchase price is $450,000, 20% down payment, 20, 40, 60, 80, 85, 90,000, say 90. 90K, you have to come out of pocket. It's about 100 grand, right? Say you bought a note for 90K, right? Same 90,000. It's the same $90,000, right? That you're going to ultimately deploy. You're still probably going to have some maintenance. You got to get the property turnkey. You know, within your inspection, not every property is satisfactory. You're probably going to need to either furnish the unit or you offer it unfurnished. We'll leave that out. Average rental rate here in the Valley is $2,000 or more. So say $3,000 for a 3-2, $500,000 home here in the Valley. 3K, 3,000 rental. 3,000 rental, 90K in. You probably had an additional 20,000 unless you're buying it turnkey in rehab. So you're really all in for 110. 110K, right? 110,000 all in for 90,000. Hopefully this is in frame here. May scoot this over just a tad. But the mobile mailbox money program, you had no maintenance, no issues turning it turnkey. The property's already consummated, qualified, and cash flowing. They call that pro forma. Pro forma. At 90K, you bought a pro forma asset, cash flowing, consummated, and qualified. For 90K on a long-term rental strategy at 9% with a $20,000 margin, not margin, but for incidentals, right? So maybe you had some electrical you had to establish, maybe a new water heater, maybe you had to rehab a bathroom to get it to a turnkey program, right? Your all-in's 110. Your rental average here in the Valley is 3,000. For a remodeled unit, you know, something in a semi-desirable area, you bought for $450 was your purchase price. $450,000 price plus the 20K, you're all in. $470,000, right? 450, you put up 90,000, you had 20,000 for incidentals, maintenance to get it turnkey, right? You had 110 into the door in order to offer it for rent, right? You may have a management company, we'll talk about that later. You offer it out for rent, for say 450 is your purchase price. Well, let's put this in a mortgage calculator, or actually a DSCR is interest only. So hold on, give me 1 second. 450 times 0.09, which is the interest rate, divided by 12 payments. So 12 months of payments is $3,300 a month. Real time, people, 9% interest rate, DSCR loan, even if it's 1% less, we'll talk about that in a moment. 3,000 is your average rental, 3K. At a 9% interest rate, $450,000 purchase, right? You have $110,000 into the property. And you're negatively cash flowing. 300 off the rip, minus 300, minus. Here in the valley, it's a terrible 3. Right in little sideways here. 3K, what's 3,300 minus 3,000? Your payment's $3,375, right? So you're already losing $300 a month. Average appreciation here in the nation, appreciation is what? Does anyone know? 5 to 8%. So let's say 5% on the low end. 5% average. 5% average appreciation on a $450,000 home. What is that? Times 0.05. 450 times 0.05 is 20K a year. 22.5. Potential appreciation yearly. 22.5. Right? You spent 450. Your potential annualized appreciation is 22.5 divided by 12 is 1,800, right? So that's like $1,800 monthly in appreciation. You're losing 375 in cash flow, right? You probably paid a management company in order to get it rented. And those are like 3%, 3 to 5%, depending on what that looks like. So your first year, 22.5 potential appreciation. That's what you're aiming for. We're at a plateau of appreciation. Plateaued appreciation. Just from the Cromford Report here in Arizona, from Arizona Real Estate Investors Association, the senior housing analyst, Tina Tamboer from the Cromford Report. Right? So here's your long-term rental strategy. Here's the numbers, people. If you're looking on the sideline and you have money, you're looking for a safe, stable return outside the stock market, you go look into a long-term rental strategy. Here's the numbers right here in the valley. Okay, you're losing $300 a month. Your potential appreciation's potentially 20K, right? But we've got plateaued appreciation, right? That's at a 9% DSCR loan. You're 110 in, so you burned $110,000. Trying to achieve a passive return monthly cash flow, but with your interest rate and the monthly cash flow, it's not so much an income-oriented investment strategy. You're more banking on the appreciation of, say, $20,000 on a 5% net average of average appreciation nationally, right? But we're at that plateau. That could be about $1,800 a month. So on your monthly cash flow, say if you were to try and establish what your net operating income annualized is, so you're losing $375, $1,425 monthly. So you're trying to make about $10,000 to $14,000 on $110,000. Boom, 10K to 14 annually on 110. What's that NOI on speculative appreciation? 110,000. Whoops. 110,000 divided by, say, 14. No, I'm doing that wrong. No, it's 14,000 divided by 110. It's 12%. So it's on speculation, right? That's your NOI excluding management fees, right? So if you hired a management company, you're really out of pocket another 3 to 5% plus maintenance. You know, you'll have additional ongoing expense, right? So this is no toilets, no AC calls, you know, no management fee. That's before all of that. Ultimately, in property insurance, you know, property insurance gone up. So before your ongoing, you know, expenses associated with owning the asset, which that could be, you know, 5% of your return net of a $450,000 purchase price times 0.05. Whoops. 450,000 times 0.05 is 22.5. It's literally the same as your appreciation. So about $20,000 a year on a $450,000. So you broke even after your property insurance, maintenance, taxes. You probably lost a little money actually, right? So that really kind of starts to dig into your cash flow as well as your net operating income annually. You know, appreciation's plateaued. Let's go to the mobile mailbox money version, right? So a first lien performing asset that's consummated, qualified, and cash flowing in affordable housing. In affordable housing at $90,000. Pardon my handwriting here, we're writing off to the side here, right? Consummated, qualified, cash flowing, the same $90,000 with no additional $20,000 out of pocket at a pro forma cash flow double-digit yield. What did I just say? Double-digit yield, which could be associated, you know, with like a 12% number, you know, 2 digits. You know, what does that look like on a $90,000 average acquisition with mobile mailbox money? We'll grab out my handy dandy Carl's mortgage calculator. All of our notes are 20-year amortization schedules. Allergies are going crazy today, pardon me. Right, 90K, 20 years is 11, 19, 17. Monthly, right? $1,000 a month. Monthly with a first lien position. First lien, if you know note investing, you know what that is. That's your collateral on title with no management, maintenance, property taxes, insurance, or any headaches associated with actually owning an asset. Why is that? Because you became the bank. You became the bank for $90,000, got a first lien, consummated, qualified, and cash flowing, pro forma, double-digit yield in affordable housing. Affordable housing, which is a state of emergency right now. Oh, did you hear about that? Sounds like a safe place to put your money in the solution to the affordable housing crisis. Cash flowing, consummated, qualified, $1,119.17 a month for 20 years. Did I just drop a bomb right there? 20-year cash flow, no problems owning the asset because you became the bank with your collateral, right? Your name's on title, cash flowing $1,000 a month with no banks. No banks. What does that mean? That means we didn't need a loan at 9%. No banks. $1,000 a month. No management maintenance. Potential appreciation to hedge. You created a homeowner in a seller finance note in manufactured housing, investing like Warren Buffett, cash flowing $1,000 a month. Net. You netted $1,000 a month with no management, maintenance, property taxes. Grab your mortgage calculator. I can't show you what the interest rate is and your potential return on investment, but if you know about note investing and you know about having a mortgage calculator, you can type this in. $90,000 was your unpaid balance for 20 years at 11, 19, 17, and tell me your jaw doesn't drop when you do your calculation. As a savvy investor, when residential real estate is pressurized, interest rates are counterintuitive to a capital investment standpoint. For a cash flow you're wanting what? Financial freedom to start receiving income outside the stock market, not lose money in a multifamily syndication play, have a first lien collateralized investment opportunity, private lending, creating a homeowner at $1,000 a month on average or more a month with mobilemailboxmoney.com, or invest today with Silvercrest Opportunity Fund. Silvercrest is an accredited investment fund offering a 506c 1-year term at 10% net paid monthly, or 3-year term at a 12% net paid quarterly. Invest like Warren Buffett today, or buy a note with Mobile Mailbox Money. Little competition in my arena. Need a house, man, you call Serena. Strategy so boring, didn't even mean to not remind them. There's another check right behind them, right behind them, right behind them. 10% passive. The checks I've lined with collateral. 150 performing notes. I think I should take a sabbatical. Adaptable with the terms. Justify that 1 year that you earn. 10% in bank quality notes if the market has you concerned. Accredited investors seeking stable returns. One thing I've learned, being burned, you gotta invest long term to move the worm into the urn. Turn the page, turn and earn. Earn the page, earn. Learn the way, earn. Earn the pay, earn the pay. Earn the pay, earn the pay. Passive. Really, I think this massive. Stable cash flow, lavish. By the finance for the masses, this 14%. In manufactured housing. Really, all the deals I've been doing is kinda hard to keep on counting. Not really.